In this video, we're going to take a look at two sample investment portfolios. The first portfolio we will look at is what's called a couch potato portfolio. It gets its name because it doesn't require a lot of maintenance. But don't let the lazy approach fool you. Couch potato portfolios can outperform most investors if you let them. A typical couch potato portfolio involves using low-cost index funds to create a complete portfolio that only needs to be rebalanced on a regular basis, for example, once per year. Here's an example of a typical couch potato portfolio. It has a 25% allocation to Canadian stocks, 30% allocation to US stocks, 20% allocation to developed market stocks, and a 5% allocation to emerging market stocks. There is also a 20% allocation to short-term bonds. Once an investor has set up this portfolio, really all they have to do is keep adding money to their portfolio and try to keep these weightings intact. They may rebalance once per year, or they can use the addition of money into the portfolio to buy units of the funds that are most below target, or they can use a combination of both. Let's look at another example portfolio. Suppose we have an investor who started investing in technology stocks. They initially bought 5 stocks that were all large cap growth stocks from the US. This wouldn't be a very diversified portfolio at all. They decide they want to build out their portfolio and reduce their risk. They might use an actively managed fixed income mutual fund to make up 30% of their portfolio. They might round out their US equity exposure by adding in a US mid-cap equity index ETF and a US small-cap actively managed mutual fund. Their total US equity exposure might be 30% of the portfolio. They might add in 30 individual Canadian stocks that are broadly representative of the Canadian market, and this might be set to around 20% of their portfolio. And for the remaining 20% of their portfolio, they might choose a developed markets index ETF. This represents a much more rounded out portfolio than what they started out with. They would still want to rebalance the portfolio from time to time, but perhaps they might modify the weighting slightly over time based on their view of the markets. This portfolio would take more time to manage and monitor than the couch potato portfolio, and the costs would also be higher, largely due to the actively managed funds.